Hello and welcome from the Nasdaq market site. I'm Jarrett Banks of IPO Edge. Joining me is a return guest, Don Duffy, the president of ICR. Don, welcome to the program.
Thanks for having me.
Great, let's get right into it. IPO activity seems to be picking up. Do you see the IPO window continuing to look friendly going forward?
Yeah, the way I would describe it, it's open and it's slowly opening more. It's a pretty good sign. I think what we're seeing out there is a combination of companies that got stuck in the pipeline last year and even to some extent in 2022 that were ready to go. But because of market conditions, rates moving up, volatility, they chose to put things on hold. So a lot of these companies kept their registration statements fresh and they were prepared to go and they've launched. And so I think what you've seen now is 30 plus IPOs this year, raised over 16 billion year to date, which is about double the amount the same time last year. So it's a good sign. And I think there are a lot of companies beneath the surface similarly that are still in that holding pattern, that are waiting to go, whether they make that choice either summertime or post-summer, I think will dictate how robust the IPO market is here between now and the end of the year.
Now, we spoke about this backlog before. How large is it and is it growing?
Yeah, great question. It's huge. Now listen, you have over 1,000 unicorns out there. It is a very, very large market, but I'd actually describe it another way. I think a couple of the big private equity firms have actually said there's several trillion in assets captive in private equity and venture capital that need liquidity. And so depending on what you define as what's appropriate for the public markets, it is extremely large. Now, the question of how we work through that backlog is important. You're seeing, let's take an example, in a mostly venture-driven market like healthcare, you've seen an uptick in biotech offerings, one priced last week that traded well. So you're seeing some movement in some of these areas, and historically, biotech's been a pretty vibrant market that is, really was shut down for the most part the last couple of years. Tech is what everybody talks about. You've seen a couple of transactions go, some digital, some software, one priced just last week, a revenue management software company. That pipeline is very large. And again, I think particularly in tech, you've also seen a dearth of deals in the last 2 years. And then you've got these private equity portfolios that are fairly large. They have a slightly different issue. They tend to be patient, but a lot of funds that held assets that wanted to go public in 22 or 23 didn't. And so when you think about an average private equity firm's holding period, maybe 5 years, they may be in year 6, 7, going into year 8 now. And I think that's the real question about what drives this market, where you could see a lot of private equity owned assets push harder in the next 6 to 12 months because there is a liquidity window and they need to get liquidity. I'd say the one other thing to turn this around a little bit, think about all the investors that have put capital to work that are not getting liquidity. That's actually what I like to think about as beneath the surface that potentially can really drive demand. What we haven't seen is, I'll call it the venture and private equity investors go on strike and say, hey, I'm not investing in your new fund until you get me some liquidity back. I think it's getting closer to happening though. I think they're running out of patience. We're hearing a lot, we're seeing some stories, but they're essentially saying, return some capital to me and I will reinvest in the next fund. And I think the managers are starting to hear that. I think they're getting a little bit more anxious. And I suspect that they may push a little harder in the back half of the year and certainly into 2025.
Great. Are you hearing from clients about the presidential election and how that may impact regulations, specifically at the SEC?
Yeah, really, really good question. A lot of people talk about the election's impact on the IPO cycle. The reality is, if you look back over the last 5 election cycles and look at a number of IPOs in that year, it's actually a non-event. Where it is an event is in November. I mean, people will not tee up an offering right before or maybe shortly after an election. I think the other thing is, just from a business standpoint, I think businesses that are trying to time it or better understand what's going on. Look, there are certain sectors that may be more or less impacted. If I am a clean tech company, am I concerned about some aspects of the Inflation Reduction Act and the benefits it has for me, and could they be stripped away? in an administration changed. On the flip side, I think you may have some that are thinking about maybe a lower cap gains tax environment if it was a more tax-friendly environment. I think it's hard to say. I think companies in general, if they have been in this waiting period for a while, they're getting prepared to go. I think if they haven't, as this market opens, certainly nobody wants to miss the next window. And so I think generally companies of size and scale are paying attention.
Okay, if I'm a private company right now looking to go public in the next 12 to 24 months, what should I be doing?
Yeah, readiness is the most important thing. I think when we get out and talk to people, there's a few key areas. There's things they need to do internally from an accounting standpoint, just to be prepared to be an SEC reporting company. So that's key. Two, visibility. We help a lot of issuers with this because, as I always like to tell people, when you go public, you don't want to be meeting people for the first time, asking them for a check in your IPO. So what we really do is help them think up strategically about who are the most important potential investors, who are the most relevant sell-side analysts that cover their space, who are the banks that they should be talking to. So we really help companies think strategically about that process. And then I think the last thing is they really want to start acting like a public company, even though they're not. What does it mean to report quarterly earnings 30 plus days after your quarter's completed? Have you built a financial model and looked at it on a quarterly basis? If you're a private company and you have a private equity or venture investor, they're not hyper-focused on your quarters. They're looking at your full year budget. But really to get into the mind of a company, and we do this today, we probably have 40 companies we're working with that are acting like public companies, although they're not yet, because they really want to be completely prepared when they eventually go public.
Okay, now we've seen a few SPAC IPOs recently, nothing like what we saw a few years ago. Is that market bouncing back?
Yeah, it's an interesting market. It has changed. I would say bounce is probably an aggressive term, since there were about 600 SPAC IPOs in 2021. The way I would describe it is it's normalized. And normalized is, I think the SPAC market can accommodate, let's call it 30 to 50 IPOs a year. I think the most important change that people may have missed, and there were 10 SPACs that went public this year so far. I think they raised about $1.7 billion in capital. But all of the SPACs in the second quarter to date have all been repeat issuers. And people would be like, well, why are repeat issuers coming back to market? We predicted this last year. The repeat issuer, I should say SPAC sponsor, is a serial SPAC platform. These are almost like mini private equity firms. They're very sophisticated. They have some of their own capital at risk, and they understand what it takes to sign a merger agreement with a company, take them through a de-SPAC process, and then help them transition into public company life. I think what you're going to see from here to the end of the year is more of the repeat issuers come back to market because they understand how to get deals done. And companies, if you're going to pick a SPAC as a partner, you would rather have a partner that has done it 2 or 3 times before and understands what they're doing and has capital at risk than a partner that's doing it for the first time. And so I'd say encouraging signs from the SPAC market, but I would call it normalized now.
All right. Now we've seen a pickup in convertible deals as well. How does that fit into the picture?
Yeah, look, if you're an existing public issuer today, you're seeing a very robust convert market, and that's primarily because anybody who has bank debt, and let's say they had it fixed or they had some hedges against it, and if it was variable, they know this real time. The cost of capital's gone up dramatically. So in the last 18 to 24 months, if you had any variable debt, your cost of debt has probably doubled to you. So what are they doing? They're looking at the convert market to refinance that. It's a much cheaper source of capital. It has worked well for companies. So you're seeing a lot of convertible issuance. The other thing you're seeing is about 4+ years ago, when the market was rallying into 2021, you saw a lot of companies issue converts. Now, if those converts haven't converted out, they have to be refinanced. And so typically the term on those is about 5 years, and you want to be thinking about that 1 year in advance of the convert. So if you're a 2020 convert issuer, you're expiring in 25, if that convert is out of the money, you have to pay it back. And so you're seeing a combination of activity from those two standpoints, and that's driving a very robust convert market.
All right, we'll leave it there. My thanks to Don Duffy, the president of ICR. This is Jarrett Banks signing off from the Nasdaq Market Site.